Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 23 years in the game, so you skip the mistakes we made and go straight to property investment success. And today we'll be discussing rental yields. Do they match property growth?
Yeah, this was a question from Chris, is it? Have you got the question there?
Yes, let's on the big screen. So we're going to have visual aids. So as always, you can watch this visually on any of the podcast platforms. But let's have a read of what Chris has messaged through.
Yeah.
So,
Hi, Jeremy. Always been interested to know if yields remain constant over the longer term, 10, 20, 30 years. Do yields catch up to price growth? Are the two linked? Do the same demand factors that increase price also drive rents? Does gentrification increase yields? Everybody seems to talk about price growth over a period, but not yields. They are a point in time. Regards, Chris. Good question, Chris. Thanks very much for this. I really enjoyed doing the research for this.
well, it's a great question because I've heard it over many, many years of advising and clients asking in the modelling that you do, like, does rent actually catch up or maintain with growth?
Yeah. There was one part of your question, Chris, which I couldn't do. Does gentrification increase yields? Gentrification is a little bit of a subjective kind of measure, and I didn't really have data at hand to answer that, I'm afraid. But I think the really important one there is rent growing at the same rate as property values, or is there some sort of difference? So that's the sort of research that I did there.
Let's start with, I guess, what is rental yield?
What is yield? Good one.
Okay.
Yeah.
So let's just, on the screen, what we're going to do is yield is pretty much, let's say, the total rent that you receive for the year from your rental property divided by the property value. Okay.
Right.
So for example, let's say we get $500 a week rent. That's $26,000 in rent for the year. If your property is valued at $500,000, your yield is 5.2%.
So 26,000 is 5.2% of 500,000.
Correct. So 26,000 divided by 500,000 is 5.2. Now, Jeremy, how does the rental yield change?
There are a couple of different ways in which yield can change. Let's say that property value went down from 500,000 to 450.
Let's say
or 400.
We'll say make it tough for me. You want to go 450, it's going to be tough. I've got to take the zero away. So 400,000.
Right.
Now the yield has gone to 6.
So that sounds really good because you're getting a much better yield now. But the problem is
the price has dropped.
Lost $100,000 to the value of your property. So yeah, high yielding markets can sometimes be property values could be in free fall. So a high yield is not always a good measure of a good market.
What's the other way that the yield can change?
The rent goes up. So what have we got there? 500. Let's say goes to
600.
Goes up to 550. But all right, 600.
Why 550?
600. Yeah.
600. Now the rental yield has gone up from 5.2 up to 6.24. So it's gone up by 1%, but that's because the rent has increased. And in recent times, rents have significantly increased across Australia pretty much, haven't they?
Yeah. So what could happen is you have the rent go up from 500 to 600. Can you change the property value from 500,000 to 600,000?
That's it.
And we've got the same yield. So yields can remain the same if rents are growing at the same rate as property values.
So if the rent was, let's say, $500 and was valued at $500,000 a year ago, and then today you get $600 a week rent, and the value of the property is $600,000, the yield stays the same because you've had both rent growth and property growth.
Yeah. And what people are concerned about, well, historically anyway, is that property values have been exceeding rent increase. Well, property increase in values has been exceeding rent increase in values. And so what I did to try and answer this question is I plotted a chart showing the yield. This is for the nation. So again, if you're not watching, apologies about that, but you can check out our these slides on say YouTube. So what I've got here is the national yield from 2004 to it's up to 2024. You can't see on the bottom right of the chart there, but we are in. This is data up to and including February 2024. Now, yields don't go back. I don't have any data prior to 2004 on yields, so I can only go back 20 years. That's why the title of the chart is showing 20-year yield history. But the white curve is the nation's median yield. And you see that it's gone up and it's gone down. It's had its eras, its good days, its bad days, and right now it's still a bit lower than its 20-year average.
Well, if you have a look at, let's say, 2016 and 2019, I know that yields weren't moving much, but there was price growth. Actually, maybe for a future episode, what we could do is mark a line of the national yield average and the national growth average. So we sort of see two different lines. Would we look at that or not?
Well, are you talking about rent or yield? Rent growth, national rent?
Well, I think national rental yield versus national growth percentage per annum.
Right, and that would be to show here's an era where there was tremendous growth in values and that's why the yield went down.
Or potentially, that's right. Because at the moment, like what are we seeing? Rates have risen quite aggressively, but property price growth has also happened and rent growth. So we've had both, haven't we? We've had property growth and rent growth.
Yeah, but as you can see, in the last couple of years,
it's picking up over here.
Rent growth has exceeded property growth, and that's why the yield has gone up. But looking in the middle of the chart, that's where there was a peak in yields. So the most amount of rent growth versus property growth was around, what was that, 2012, 2013, where the chart's at its highest. So I've also got combined capitals in there and regionals. Regionals usually have higher yields than the combined capitals. But yeah, they all seem to follow the same kind of pattern, but there are eras where yields are flat. There are eras where yields go up, eras where they go down, and I believe that right now, with all this high rent growth, it's just coming back to normal. Yields are getting back to normal.
We can see this is sort of like what COVID, after COVID, and the markets were sort of moving, but rent wasn't increasing. Vacancy rates were higher. Potentially people going back home overseas maybe, or moving back with their family members. I know areas like, Docklands or maybe areas like Alexandria, all those type of areas where there's a flood of high rises, vacancy rates shot up and then rent growth dropped. But if you look at the trend recently, the rents are through the roof.
Yeah, and also that same period there where the yield's dropping, that can also be argued by prices going up because
Correct.
Interest rates were so low, everyone saw an opportunity to enter the market. That placed pressure via demand, and so prices went up, yields came down.
And it's interesting to see it sort of just really pick up.
Yeah, recently we've got interest rates putting a little bit of a dampener on value growth, but rents climbing as property investors try and combat that higher rate of inflation, that interest cost.
So what have we got over here? We've got 20-year yield history for Sydney, Melbourne, Brisbane, Perth, Adelaide, and most of them seem to follow the same sort of trend, don't they?
Yeah, so I just was wondering here, is it any different in the Big Five? And certainly for the last decade plus, yields have declined in the two biggest markets of Sydney and Melbourne until just the last year or two where we've seen rents climb at astronomical rates because of low vacancies. But yeah, look at Perth. Perth's probably the only one where it is at a high compared to its 20-year history. That's pretty high there. So if you were looking at this and wondering, are rents going to go up even further in Perth, you might argue the case, well, no, they're probably back to normal now. But it looks like there's a fair bit of growth still required in all the other markets just to come back to what they would consider as normal.
Good stuff. Good research. How long did that take you?
This was only about an hour, maybe two.
And I think it's a key point to also make. So back to Chris's question, I think it's a key point also to understand that, like, you're gonna have, as you mentioned, different time periods, aren't you? Like where growth might go and then yield might plateau, or then yields will pick up and growth might slow down, and vice versa. And the thing is, if you've just had consistent price growth, but you haven't had a rent rise for a couple of years and you're worried, well, eventually they'll sort of come back in line. Otherwise, you'd move your money out of an investment property and then I might go purchase an index fund instead because I'm getting a better yield from a better cash flow perspective buying index funds compared to buying a property where the yields are continuing to drop.
Yeah, that's the thing about supply and demand. It's in a continual tug of war and it tends to just balance everything out. If you have property investors leave the market because conditions aren't favourable to them, that lack of rental property means that vacancy rates plummet. Demand from tenants is still there because humans still need a roof over their head, and the rents start to go up because of low supply. That then draws more investors back into the market and the whole cycle repeats. So you don't need governments mucking about with it. Wherever there is a demand, you'll find an investor or an entrepreneur to capitalise on that, and it just makes the world go round, and eventually it all balances out. There can be some ugly situations in the meantime while you're sort of waiting for that to happen, but it does sort of balance out.
A quick point, would you use, I guess, like a rental yield for some sort of analysis to go buy your next property? I would mainly just look at it from a perspective of, hey, how's it going to impact my cash flows? So if I'm saving $3,000 a month now, how does a yield of, let's say, 4% at a price point of, let's say, $500,000, how does that impact my cash flows after I buy that property? So before cash flows, or what are my cash flows after? But I wouldn't mostly look at it and go, oh, there's going to be this much growth because of this yield.
That's right. Yeah, yield is probably not one of the best indicators of future capital growth. But it can, in some circumstances, be quite a good precursor to capital growth. But, the same sort of demand-supply imbalance that pushes prices up, that's because there are buyers interested in the area. They find the place attractive. There's schools, shops, whatever it is, affordability, maybe that's it. And the same sort of thing is influencing the decisions of renters as well. It might not be at the same time, and that's why you see yields fluctuate from era to era. But if you are in a market where demand is in excess of supply, then you should see both prices, values, and rent go up.
Great question, Chris. Hopefully,
thanks, Chris.
If listeners have any questions, they can leave a note in the comment, and we can decide and go through it in future episodes. They're great, aren't they?
Yeah, if this is the sort of content that you like, click on the like button, give us some feedback in comments. If you're hungry to devour more, then just click on subscribe. And if you think this is of interest to anyone else, well, there's a share button too.
Yeah, so subscribe, like, and share to the world. And thanks for tuning in, and see you in our next episode. Bye for now and take care.